You're watching a Carolina Business Review special presentation in partnership with the Charlotte Chamber of Commerce. Major support for this program provided by Babson Capital Management, a leading global asset manager with over $200 billion in assets under management. Learn more at babsoncapital.com.
In just a short while, all of this space behind us in the Charlotte Convention Center will be filled with seekers and leaders and policy wonks and community advocates and CEOs and press, and in general, those folks that want to be engaged in the important dialogues of the day. I'm Chris William, and welcome to the longest running and the most widely watched source of Carolina business and public policy. And as we celebrate 25 years on the air, we will do so with the most prominent business leaders in Charlotte and the Carolinas in one of the annual conferences that is most prolific in debate. And we start the dialogue now.
This is the 2016 Economic Outlook Conference, featuring Tim Belk, Chairman and CEO, Belk; David Carroll, Senior Executive Vice President, Wells Fargo; Susan DeVore, President and CEO, Premier; Lynn Good, President and CEO, Duke Energy; Jeffrey Lacker, President, Federal Reserve Bank of Richmond; and Brian Moynihan, Chairman and CEO, Bank of America. And now, from the Charlotte Convention Center in Charlotte, North Carolina, your moderator, Chris William.
Welcome. Thank you. I'd take that better if I knew it was authentic, but thank you so much. It's great to have you all here, and certainly thanks to our panel of just outstanding business leaders and opinion leaders. We are coming to you from the Charlotte Convention Center, specifically the Crown Ballroom here in Charlotte above the NASCAR Hall of Fame, and thrilled to have you here. Happy holidays, Happy New Year. Let's get right into it. Mr. Belk, start with you. Wow, big announcement from Belk this year, partnering with Sycamore, but sans that, Tim, when you look back on 2015, what was the most surprising thing about it that surprised you, either with Belk, with the economy, or something else?
Well, the process that we've gone through, probably that was number one. That's been huge for us this year, the journey we've been on, trying to maximize shareholder value and look at that question. And I didn't know whether we would end up staying as an independent company because we felt really good about our prospects for growth, or whether somebody else would put a higher value on that, which is ultimately what happened. So we ended up selling. And we're excited about the road ahead and our new partnership. But I didn't predict that at the beginning.
Yeah, 2015, David, what surprised you most when you look back?
You know, for me, it was the stunning collapse in energy prices and the effect that it had. If 18 months ago someone had told me that oil was going to go from $115 a barrel in the summer of 14 to this morning trading below $35 a barrel, I would have thought it would have been a boon to our economy. And the economists say that it globally added about a half a point to global GDP. And in the U.S., in the short run, it's actually detracted from GDP because of the peripheral industries, steel, transportation, sand, water, and all the fracking. So most people would have thought it would have been a field day, and it's per capita, or it's like $300 a household. So I was surprised by that.
Yeah. Susan, what about you?
You know, I would say that I was surprised by the fact that the Affordable Care Act has neither been the triumph or the tragedy that people predicted. So coverage has been expanded, uninsured rates have come down, people are focusing on changing the way care is delivered, and costs now are increasing, I think, at an even faster rate than people predicted. So I think some of it has worked, some of it hasn't worked so well, but it hasn't been a tragedy or a triumph.
Yeah, well said. What do you think, Madam Chair? What surprised you most about 2015?
So for Duke's business, the biggest surprise was the collapse of emerging markets. In Brazil, building on David's comments just a moment, the low oil prices and the weakness in commodities worldwide has had a big impact around the world, in Brazil in particular, coupled with some issues around Petrobras, has just really stumbled. And so we've had a challenging time in Latin America, and it came on more quickly and more deeply than we anticipated.
Jeffrey, Dr. Lacker, what do you think?
So I think I'd say the slowdown in global growth wasn't fully appreciated at the beginning of the year. I think that's why the other surprise I had is that we didn't raise rates earlier. But I think the reason is global growth stayed our hands for a while. Luckily, the last quarter's worth of data has things looking as if there's a turnaround in trade and things are looking up there. So I think we've stabilized, and I think we're in a good position going forward.
Brian?
I think I'd say you're surprised by the different things that Dr. Lacker and David talked about, but what surprises and Lynn talked about, it surprised me the resiliency. So think about the parade of horribles that occurred out there over the last 12 months since we sat here. We all had the economy predicted a half point to a point faster growth than it will probably turn out to be. I don't think a lot of people had predicted that the first quarter is going to be slightly positive, and originally it was reported negative. I think the world wouldn't have reported the kind of activities that have gone on that are disturbing. The world wouldn't have thought that Brazil was going to fall this fast, this far. Yet the resiliency overall is that the economies of the world continue to be projected to grow, actually did grow, and grew at in the United States, not the pace we wanted, but grew at a reasonable pace for the size of economy. And it's surprising how resilient we are to shake off 2 weeks ago the high yield issues. The world just keeps shaking off this stuff. Now, the question is, are they ignoring it or shaking it off? Right now, it looks like we're shaking it off.
Well, thank you. And let's look forward. 2016. What do you think the opportunities are going to be in 2016? And let's bring it back from the global, even the national, down to the regional, North and South Carolina. Where do you think the opportunity to grow? What do you think the opportunity for a business? Where would they need to be to grow? Is that capital investment? Is that, Tim, do you see, I don't know, maybe stronger consumer buying? Susan, are we back to healthcare? Is that going to be, I mean, anyone at this point, what do you think 2016 is going to kind of, where do we go? What's it going to look like? Dr. Lacker, you want to start?
We're very careful to eschew providing investment advice at the Federal Reserve. But I'll report on what's strong now. I mean, obviously, automotive sector, aerospace, medical equipment, and the like. There are lots of pockets of strength in the manufacturing sector. Obviously, oil and gas, a weak area. Consumer spending has been exceptionally strong, and housing has made very good contributions to growth. Housing investment's been growing faster than GDP overall. So those are the areas, based on past data, one would look to in forming an investment strategy.
Yeah, Brian?
I think you follow up that the piece that's been relatively late to the party here is the jobs impact of housing that it is continuing to build when other areas have gotten weaker. For example, the oil and gas industry laid off a lot of workers early in the year, and it's stabilized. But where it goes next, based on this price, it will be interesting. But the interesting thing people forget is the housing prices are up 5% year over year plus, but the jobs, residential investments continues to go up. And that's a good thing because those jobs are the jobs that are very local. You don't import a house, you don't import a new roof on a house. It has to be done locally, it has to be done by people. And that's why I think you're going to see more, from our experts' viewpoint, you're going to see more positive pressure, i.e. downward pressure on unemployment numbers, pushing it to levels which most of us have never seen, below 5 potentially and beyond. And that is good for America, because that employs a group of people that have been a little slow getting back to work. And you hear from our housing clients, and I'm sure David hears the same thing, they can't get labor, so they're actually holding back on development, which may not be an altogether bad thing because they won't get ahead of it, but they're holding back largely because they can't get the skilled part of the labor set. And if they can get it, then they'll move forward. And so that, I think, is something as you look forward is interesting for next year. Is will housing continue to be a net positive catalyst and offset some of the stuff around oil that you see capital expenditures come down?
David, you want to jump in, and then I'm going to ask you about consumer spending, Tim, after that.
Yeah, picking up on Brian's point, I think you have to keep in mind the resiliency that he mentioned. The economy has kind of worked through some things that 2 or 3 years ago would have been really, really frightening. I'm reasonably bullish about the economy. We always talk about manufacturing, and it truly is important, but it's only 12% of GDP in the United States these days. The services sector is doing great. The consumer's doing well. Housing is doing well. Best auto year on record. Inflation is low. It's just over half of the Fed's long-term target, so we don't really have escalating prices. There was an article in the Journal this morning that said a year ago there were 18 metropolitan areas in the country that had unemployment of less than 3%. There's 31, so we're beginning to see some wage growth, which is a good thing. We haven't had that in a long time. So the services sector, technology, healthcare, I think there's a lot to be pretty bullish about.
Tim, consumer spending, if you looked at just that, would you say we're going in the right direction? We're going to be better off 12 months from now than we are now?
Yeah, we see the trends going in the right way, and I would say 2% is looking like a more solid 2% than it has been in the past, and she's buying more than basics. If you're on the right trends, she'll spend the money. If you have fringe, ponchos, activewear, she'll spend it.
I'd say that the competitiveness of the different, Tim's 100-plus year history in the retailing business, the competitiveness of the different retailing capabilities is, I think, muddles some of the real amount of spending going on, because you have the online merchants capability, you have the different formats, and as you look across our base, the overall spending levels are up 4.5% over last year's December. But you can actually see within that you're seeing this huge shift to the online spending, which is again sprayed out to a lot of brands, but the collective of Amazon and like kinds. And so that whole thing, I think, is muddling people's view, but it's very strong underneath it, that people are spending money, they have more money to spend, they're getting the benefits of gas. That serves our economy, with 2/3 of it driven by the consumer, well as you look towards next year. And I think as long as something doesn't disrupt that, we got a pretty good line. Doesn't mean it goes as fast as you want, but we got a pretty good line of sight.
So Brian, to zoom back out, Lynn, Susan, I want to bring you in on this. To zoom back out, economists will say, listen, this new norm idea that we've been putting out there, it really is. It's not going to be 3.5% GDP growth. So I guess, Lynn, Susan, how do you model, same question, but how do you model your growth based on what you're looking at?
Yeah, so the demand modeling and the growth modeling for healthcare is highly dependent on population growth, aging of the population, demographics, chronic conditions. And the demand for healthcare services is far outpacing the growth in GDP. So it's 1 to 2 to 3% higher than the normal growth rate in GDP, which means that it's a demand for facilities, a demand for healthcare information technology, a demand for drugs, a demand for devices. All of that converts to higher healthcare spending, which federal, state governments and employers are paying for. And so I think we're projecting significant growth, continued implementation of the ACA, and it will create demand in a lot of areas. 62% of our CEOs of health systems across the country say they're increasing capital spending, and 40% would say they're increasing their normal levels by 10% next year.
Lynn?
So growth for us has over time decoupled from GDP growth. So if you think about the electric sector, maybe 20 years ago, there was a high degree of correlation between GDP growth and the growth in energy. With the introduction of energy efficiency, primarily everything we buy is more efficient than it was what we took out of our homes. That decoupling has occurred. So the growth is really 20% of GDP growth, where at one time it would have been closer to 80% or 100%. And so our challenge is to figure out how to continue delivering outstanding service for customers and modernizing our system when we're expecting low growth. And so the things we look to, we love being in the Southeast because we continue to attract new customers. We like service businesses. And of course, if there is industrial growth in an area, that's extraordinarily helpful. It makes for a great balanced electric system. And so we're constantly looking for ways to drive efficiencies in our business so that we can continue to provide great service at a low cost to customers.
So, Dr. Lacker, we talk about slow growth like it is in passing, that it's temporal. Is slow growth the new status quo? Is this how it's going to be going forward?
So I think a case can be made for that, but I also think a case can be made that we shouldn't be as disappointed about it as you might think. So for one thing, the growth in the working age population is much less than it was in decades past when we became accustomed to 3, 4, and 5% GDP growth. So you have to handicap it on that basis. The way we measure productivity growth, measured productivity growth is relatively slow. So we count employment very well, we count the number of hours worked very well, but the actual real value adjusted for quality changes of what people buy, that's very poorly measured. And right now we're going through a period where measured productivity growth is low. Those measures can be revised fairly substantially over time as we get new data, new techniques are used. We experienced this with the whole tech boom in the 90s. After the revisions, the productivity picture was in much better, much more clear view. So I tend to discount the GDP numbers and look at the employment growth. And there, we're getting in growth numbers that are well above the rate we would need to keep pace with the growth in working age population. So I think on that basis, I think we should feel pretty good about this economy and the performance it's turned in since the recession.
One of the ongoing themes has been capital investment, has been deploying cash. Some folks have said, well, the banks aren't lending cash like they were. Tim, capital investment. Are you sitting on more cash than you normally would? And if you can take Sycamore out of the deal, where are you in the cycle about deploying more cash? Where would you make reinvestment? Or what keeps you from doing that right now?
We're in a capital-intensive business with this digital transformation rumbling through retail. It requires heavy investment. It requires you to reinvent your business model. You know, how customers buy, how customers want to receive the things they buy are creating large changes. So that creates a lot of need for capital going into the business.
Is there a capital investment dearth in your industry right now?
No, capital investment in our industry is very strong. People are building the infrastructure to take care of populations in communities and take risk for that. And that requires huge capabilities in technology and data analytics, as well as facilities and other things. So we see continued major capital investment.
Back to the bankers. David and Brian, I'd like you both to weigh in on this. A lot of people will say that banks aren't lending the money like they should, like they're making. Is that about a regulatory handcuff? Is that about a lower growth on the rates? First of all, David, I'm assuming you agree with that statement. Do you agree with that statement? And is there a better way to get capital out?
Yes and no. The facts would suggest that bank lending is quite healthy right now. The Fed's most recent numbers are just shy of 8% year over year. By any historical measure, that's a very healthy clip. Another thing, this is more of an economic statistic, but business capital investment tends to run at about 12% over long term, about 12% of the GDP. It's about 12% right now. One thing that's happened since the financial crisis that has absorbed a lot of the investment that otherwise would have gone into things like plant and equipment, we're in a slower growth economy. Business leaders need to see demand before they're going to venture to risk the capital. And since 2009, while the S&P 500 has more than doubled, public companies in this country have bought in about 15% of their market cap. So they're investing kind of in themselves. The best investment opportunity a lot of CFOs and CEOs see is their own company. And so the facts are a little different than the common perception, I think.
Yeah, Brian?
I think that if you look at loan demand, for creditworthy borrowers, as David pointed out, you're seeing good C&I growth across the industry. It's to the point now where people are wondering, is it growing too fast? And that's the inquiry, especially in commercial real estate and areas like that. But we're doing more originations than we've done at any time in the last 7-8 years. The outstandings are growing. And so I think the idea that credit's not available, especially when you go to average middle market company, is they have a line of credit they can draw, and they're still drawing higher than they did, over the last several years, but still sort of on the average of where they've drawn, around 40%. So they could borrow the money if they have an opportunity, and I think it comes more down to what Tim and David are expressing, which is when the opportunity is there, they'll borrow and do it with a slower growth environment and more things that they can see out there to make them nervous, and more global connectivity, which means they have to think about more places. They can't just think about North Carolina. They can't just think about the Southeast. They have to know what's going on in Brazil. They can convince themselves of the demand side movement at any given moment. And I think that has a necessarily conservative effect on them. And so you're seeing that come through when people are getting more aggressive, and then we give them something to think about. And so I think if we can kind of have a smoother path, I think that you got a pretty sure path to growth that's reasonable. But it's not, I don't see it driven by a credit demand. I mean, I see credit availability for the companies that need credit is out there. The markets are open and doing it. Wouldn't want to be an oil and gas company trying to go to the market right now. But other than that, stuff's going fine.
Yeah, reflecting on the capital-intensive nature of utility business, Lynn, do you get it when it's not fair to say, Lynn, which I think you'll understand, when people say that companies are not investing like they have in the past? Do you understand that? And how do you take advantage of a low-cost environment for yourself?
So, Chris, we are one of the most capital-intensive industries in the U.S., and in the Carolinas alone, we have over $5 billion of investments that are underway in the form of infrastructure in the state. And what I would say to you is capital investment is something that requires very careful analysis. The changing dynamics, whether it's technologies, whether it's regulation, whether it's customer behavior, whether it's a new commodity that's going to be discovered tomorrow that'll be disruptive to what you're trying to accomplish. You're trying to be thoughtful because capital means I want it to make sense for 10 years. I want it to make sense for a long period of time. So I think the analysis is really important, the thoughtfulness, trying to put it in places that you think will deliver value to your customers but also be sustainable. I think that's where the hard work is. And when you have a period of uncertainty in any element of your business, I think that makes financially disciplined people thoughtful about how they're going to put that capital to work.
Is Duke deploying capital like you would have deployed capital a decade ago?
I would say we're deploying more capital than we did a decade ago. And if you think about what's going on in the energy industry, complete transformation, whether it's technology to support what customers need and want, or it's the transformation from coal to natural gas to renewables, every element of our business is undergoing change, and capital deployment is necessary to enable all of those technologies. And so we are benefiting from low gas prices, keeps prices low to customers. We're continuing to drive productivity in our business to offset that cost of capital in our customer rates, and that transformation is something we see going on for the next decade.
What capital is, as Dr. Lacker said, is a little bit more, is different than it was in the past. I mean, people think capital, new power plant and stuff. We spend $3 billion on technology a year, developing technology. And that's been fairly consistent. It's probably 3 times the rate we would have spent 10, 15 years ago. And so it's capital investment. It's not capitalized that much of it, but think about how many programs that puts to work. 1 million lines of code or more go in every single weekend except for 2, because we try to take 2 off to give the people. So think about all that. Now, that isn't a plant going up, but that is a consistent amount of investment that's going in. And by the way, we're not unique there. So that's part of the problem of all these measures of what capital is and investment is. When you get into things, intellectual property, technology impact, what that enables a customer to do or what that enables a company to do, the efficiency you get out of it, is a very different thing than a lot of these measures were built to measure, which was more traditional methods. And so it's going to take a while to shake that out as to what's happened. But what you really know is wages are growing and employment's growing, which at the end of the day is the acid test. If more people work tomorrow in our country than worked yesterday, and they get paid a little bit more or a lot more, that's a good thing. And then the third thing is can we take jobs from everywhere else and have them located here? And that comes down to ingenuity and a lot of other policy structures in low energy costs and things like that. And I think all those things are in America's favor right now. Now, we can blow it, but they're there.
Big sources of capital investment. Appropriate. Big sources of capital investment, Dr. Lacker, certainly come from flow-through earnings. They come from cash on hand, but they also come from debt and leverage. If you look at the balance sheet in this country, about 24 months ago, we had a large debate, an emotional debate going on about the amount of debt on the country's balance sheet. We haven't talked about that for a while. It's diminished to some degree, but not really. It's somewhere above $4 trillion, and I am a freshman compared to what you know here. But are we going to revisit this idea of too much debt on our balance sheet, and when does it become prohibitive to growth?
So debt's a very useful social contrivance. It's for millennia helped people align their spending with their income more felicitously than they otherwise would be able to do. So debt by itself isn't bad, but debt in moderation is important. So there's a lot of different debt out there. I think consumer debt has aligned better with their income prospects, ability to repay, value of their collateral over the last 10 years since the end of the crisis, and I think that's part of what's powering the strength in consumer spending now. The business sector balance sheet looks reasonably healthy. There's a lot of concern about the high yield sector. I think you have sectors that wax and wane from time to time, and at this point I don't see anything that indicates financial distress of a nature that would induce policymakers to come to the rescue of anybody, which is a major tripwire. So I think we're okay there for the time being. But broadly speaking, the business sector looks okay. For the country as a whole, our federal government debt, so we're running at a little over 70% of GDP. That's in a zone that most industrialized economies are able to carry, are able to manage well. But the danger lies at a period starting 5 to 10 years ahead, where that trajectory starts rising and our debt starts growing faster than our income and ability to repay. And at some point, that'll drive us to a point where questions arise about the U.S.'s ability to repay. And I think it's going to force adjustments in our fiscal policy, particularly entitlement programs. And I'm looking at Susan, obviously, in the Medicaid, Medicare sector is going to be required. The sooner we get on that, the better, the less costly the adjustments. And I would hope that dialogue you talked about, Chris, is renewed in the wake of the budget deal we just had, which is going to add to that launching off point. It adds to the debt that we're going to have at that point where things start taking off in 5 or 10 years.
And just a peek behind the curtain at some of the Federal Open Market Committee dialogues, how much does the level of debt in the country play into what the chairwoman or you as a member or other members, your colleagues on the committee, how much does that play into when you talk about interest rate policy?
Well, in my experience on the committee, and it's been over 11 years, I've never heard the interest expense on the federal debt enter into a conversation about interest rate setting. It's the economics of it, it's just not a central concern for us. We're more concerned about the real interest rates, the inflation-adjusted interest rates that consumers and borrowers and banks face, and the incentives that creates and how that aligns with what real interest rate the economy needs. So it doesn't constrain us. And we conduct monetary policy in a way independent of those fiscal pressures, because when you let fiscal pressures influence monetary policy, it's the road to ruin in some sense.
Yeah, okay. Susan, Dr. Lacker just referred to you, and we use the term like entitlement, we use healthcare, and now it's close to 20% of this country's GDP. You used an interesting term, and forgive me, I'm not going to say it right, but you used the term that it's not the worst and it's not the best. I don't know how did you couch that before?
So I said it hasn't really been the tragedy or the triumph that the pundits all predicted, because I do think you've seen people get coverage, you've seen healthcare systems start to take on this idea of taking care of populations, you've seen major investment in IT, and at the same time, you've seen costs go up, and as significant a portion of the GDP that they are and the federal and state tax revenues that they are, the cost problem when you're growing at 2 to 3% rates that are higher than the growth in the GDP just has to continue to be worked on. And I think the implementation of whether you call it the Affordable Care Act or you call it something else after the election, it will be focused on how do we improve quality, how do we improve safety, how do we make this more affordable, and how do we get the consumer more engaged. And there's been a pretty significant movement in 2015, and we think in 2016, in consumer involvement in their health care.
Do you think that will make a change on the overlay of the passion around presidential politics? In other words, will 2016 be good or bad for advancing whatever ACA is going to look like a decade from now?
I think it will be advanced as fast as possible prior to the election. In other words, I think that they will keep implementing it, because now it's largely a regulatory implementation, as fast as they can until the election. After the election, I think we will have a lot of things in place. So it's not a question of repeal, but a question of what gets tweaked. And I think that they will continue down the path, because all of us agree, even though we don't admit it if we're Republican or Democratic, but we all agree that we need to manage the cost, and quality isn't where it needs to be, and safety isn't where it needs to be. So it'll just be different forms of the same implementation.
Tim, what's your opinion on healthcare, and especially as a proprietor, where healthcare is clearly a major expense for you? How do you manage through that? What are your thoughts about it? Almost same question for you that Susan. What do you think is going to happen in 2016 and beyond for healthcare?
We see rising healthcare costs ahead on the horizon, and it's been fairly flat. We've been pretty good so far in managing that, but it's one of those line items on the income statement that is going to go up, and you're going to have to find ways to offset it. And at the same time, you want to send a message to your people that you care. You care about them. And so, you're basically trying to juggle those two things. and do it well and do it to their benefit.
Lynn and I were talking backstage about employer initiatives around healthcare. And I talked a little bit about the consumer, but even at Premier, which is a small company, we have moved from what was 10% employee engagement in HSAs, these healthcare savings accounts, to 66% this year. And our data would indicate that people with healthcare savings accounts get engaged in their healthcare. They're choosing between retirement planning or spending healthcare dollars. And it lowers the cost of healthcare for us as a small company by 10 or 15%. So I think we're going to continue to see this movement to high deductible plans, healthcare savings accounts. Employers and all of you would be subject to the Cadillac tax on your health insurance programs if it continues to move forward. There's discussion of that being delayed, but so many employers that we see are really challenging their healthcare insurance models, and how do they get their employees more engaged?
So when does healthcare become a prohibitive to business development other than a very large expense item on your income?
I think healthcare is something that can differentiate. You certainly, it's part of a package of benefit offerings to employees that for a company like Duke that's been in business for 100 years, it's an important part of what we offer to employees. And we've had great success moving and educating employees to be better consumers of healthcare. And I'm proud of what we've accomplished with wellness programs. To Tim's point about caring for employees, we've had a lot of adoption of wellness programs, and it fits very consistently with our culture of safety at Duke Energy. So I think you can look at it as a problem, or you can look at it as opportunities to not only enliven and attract your workforce, but also, to improve the healthfulness, and that's the way we look at it at Duke.
Yeah, Brian?
So we've been working at our company, and I work with a group of CEOs for large self-employed companies, 200,000 plus employees. We have 1 million people we self-insure. So any movement in that is substantial. So we started on really along 3 dimensions. One is we're going to make healthcare extremely affordable for people paid in the lower ranges of our company, 20 hours a week, full healthcare coverage at about 10% of the cost is the people paid above that. And then engage them in the efforts to help drive down the overall cost and bend the cost curve over time. And so we have 100,000 people who log their steps in. We have 30% more people in the low risk factors over 3 years than we had a couple of years ago. And all that allows us to shape that curve out there and then invest it back, and then we get to some innovative stuff. We're bringing to all the employees ability to get DNA screening and cancer screening and stuff that we're beginning to run the pilots on that gets them access to health care that is very special because of the way we can buy it and the way we can actually get it to them. That is really kind of neat. And I think for us, we have almost $30 billion a year in personnel costs in the healthcare part of that, less than 10% of that. So it's not a cost, but you're really going to Lynn's point, which is to be the employer of choice we all want to be. You're going to have a completely competitive methodology, and you're going to have to actually have avenues of which your employees can manage their cost even after they don't work for you, which is SSAs and long-term plans, but also helping them get their life the way they want it. And so it's all volunteer. It's all, we incent through, it's all carrots, no sticks, and it's been remarkable to see the uptake, and it's really had an impact that we can literally pass through no healthcare cost increase to employees below, the high range employees and down. We had no healthcare increase the last few years.
One of the challenges for the Affordable Care Act was really, there was a lot of prediction that large employers would abandon their health plans and their insurance, and they would move their employees into the exchanges. And that hasn't happened, and employers have viewed it as a competitive differentiator and a real investment in the health of their employees.
Do you have a different point of view on that, David?
No, I don't. The only thing I would add, just to echo something Susan said, and it's to get greater plan participant or patient engagement. The third-party pay system we have, still a lot of people think their copay or their deductible is what healthcare costs, and it obviously is not what it costs. And so all the things around wellness and employee education and taking more ownership in their healthcare outcomes, I think, and Brian said it well, to bend the curve.
Mm-hmm. If you bring this all the way back to the productivity question, one of the things that this country has that no other country in the world has is the ability to get treated in ways that you can't fathom. And all you have to do is go around the world and see how many people come here to get treated. So the expertise, the ability to actually get it, and the quality, it's amazing. And in the development of pharmaceuticals that can only really get paid for in very few societies. And so if you think about that, it is such a competitive advantage. And where that goes over time, with the amount of work that you see going on and integration between physics and biology and chemistry and computational science, behavior modification, gamification, all these things, is an unbelievable impact that I'm a complete amateur in, but watching our clients and stuff go after this stuff is just unbelievable what's going on. If any of these things stick, and some portion of them will, some will go up in smoke, the competitive advantage our country has in this area is beyond understanding on a worldwide basis. So if you can actually have a database where you have 30,000 oncologists know exactly the treatment that's going to treat Brian Moynihan down to the protein level in his DNA that worked for Brian because he had the same markers as Jeff Lacker did, and you can get that information real time to a doctor in the middle of Ohio where I grew up, that is unbelievable standard difference that people will flock to.
You know, you seem very animated by this, Brian. Seriously, what is it about that?
We got 1 million people that I feel absolute responsibility to have them have a great life, and that's what you have to be as an employer these days, and that comes down. When you are people, I mean, 60% of our costs are people. You want to have the best people who want to do the best for you, and this is one of the ways you show it.
So it sounded like you were saying something over here, Susan.
Oh, no, I was just saying that it is absolutely true, and I was thinking, that we have data in healthcare systems across the country that account for 120 million people across the country. And in this country, we've always just assumed it was a given. And I think the only challenge we have is the cost of that to us, and other countries get some of the same stuff and don't pay, for it the way that we pay for it. The other thing is what Dr. Lacker said about we have fewer working population, and that growth is slowing. We have more elderly, poor, chronically ill people, and it really is a question of the priorities we're going to make as a country in keeping people healthy and trying to work on them while they're young so that we don't have the problem later in life.
But I think but David's point is a little bit that if the plan, if the plan structure doesn't incent that kind of thoughtfulness and that kind of longevity of the thoughtfulness, yes, we've increased the expected outcome of a person in this country's age dramatically. That has a plus and a minus. The plus is wonderful that people live that age. The minus is they'll quit working and have a long period. But that's where a lot of the work has to go on. I think the Affordable Care Act, when you balance the plus and the minus, one of the pluses is I think it got a lot of employers that are really big employers who people were fearful were going to throw people in to actually come at it differently and said, you know what, I see what some of the things people worry about. I can control my destiny here. Let's go after it. There's a different debate on the public sector supported stuff that we've all got to get after, to entitlements and the cost, and does that roll the debt to a place. But the science is actually the thing that actually can work on both sides.
Right.
So if the private sector can drive the science deployment to the point where you can change, then I think you can. But you got to think of it across 50 years. You can't think of it across 5 years. It'll take a long time for the science to have the impact. But it's neat stuff. Those of you around universities, and there's not a city in this country of any size, of any great university system, isn't putting all their money in biomedical deployment of some sort, and I'm going to sponsor this with funds and everything. And that's all good stuff, because out of that will come interesting outcomes.
Are you as excited about this as we've seen so far?
I think attracting and retaining talent is something that I'm excited. I think all of us are. You're hearing the healthcare angle, but if you think about what differentiates all of us or all of our companies is the quality of who we attract and retain. And at Duke, we talk about the fact we have power plants by certain names, and you have steel in the ground that you're really proud of. But what I'm most proud of is 28,000 people who come to work every day, and another 28,000 contractors that are on my system doing various things. And if they do their very best, and if I can attract and retain the very best of them, then the success of the company is going to be extraordinary. And so I think this conversation is about attracting talent. And I think all of us appreciate how valuable it is.
Well, so that's a good point, Lynn. So small and medium-sized businesses will say, through economic developers, and also in conferences just like this, they will say that that we've reached a tipping point about finding talent, that the bench is it's shallow, and there's a thing called the worker skills gap out there. Do you see that? Do you see it's hard to find the folks for the right job?
So I think that's a yes and a no, Chris, because when I look at the talent that I see and the young engineers that we bring into Duke, if you spend an hour with the young engineers at McGuire Nuclear Station, you'll leave there thinking we are going to change the world, because they have this big view of what they can do, and they have this big view of where energy can go. And they know more about what their thoughts are on the vision for the future than you would have ever imagined of a 22-year-old or 25-year-old a long time ago. But there are gaps in certain areas where we have not developed the skills, or our community colleges and our vocational schools, to keep pace with the degree of technology that are in more traditional jobs, but where technology has really changed what's required. And so I think you've got a situation where we definitely have some development of talent that needs to occur, workforce development. I think all of us are focused on that in different ways. But I'm encouraged by what I see coming out of the universities, and the ability of these young people to grasp technology with an aggressiveness for change. I think is exciting.
Tim, one of the secret weapons of Belk has been for years. It's certainly corporate and big now, and it's got a lot of leverage and a wonderful brand, but one of the secret weapons has been you have been in a lot of these small towns in the Carolinas into the South, and you've had a pipeline directly to the community, and people have loved that about Belk, that it is a community builder. Now, I'm not saying that to build you up. I'm saying that because in markets that are smaller, how do you attract, how do you keep the talent that you need in those markets to grow, not just your top line, but the brand and the stores?
It starts with being really clear about who we are in those markets, and one of the values that we have is be involved in our communities. And so that's been a differentiator for us. We like to get out and get involved, and we like to get to know the community, and that gives us a way to attract who's best to hire there and put together programs in place to attract and retain them. So that's been a real plus for us.
Do you feel like there is a worker skills gap? Do you feel like that's a very real thing, and not just those markets, but across the organization?
I don't see a worker skills gap. I would say there are two thoughts that kind of pop into my head in that regard. One is that in some of these new areas, supply chain, network fulfillment, digital assets, website, yes, there's a skill gap there, and we are working hard to build those capabilities in our company. But the other part of that is that we are seeing certain locations such as Charlotte, Charleston, Atlanta, Dallas. It's harder to hire the quality of the people that you want, and that's because I think we're seeing closer to full employment, higher in a creeping up of wage rate. So you have to work harder, be more creative about getting the talent that you want.
Dr. Lacker is the clinician here, the economic scientist. Do you see it borne out in the numbers? Is there a worker skills gap? Is this something to be concerned about?
So a skills gap is something we've been hearing about for a long time from our contacts around the Fifth Federal Reserve District, which goes from Maryland down to South Carolina, includes most of West Virginia. And my colleagues around the FOMC have been hearing that around the country as well. It does show up in the numbers. And I'll just mention income inequality. I mean, it's something that I think any literate person knows now, is that since the 1970s, the gap between the incomes of those with education, college degrees or more advanced, even a high school degree, has spread out from those who lack skills. That's in some sense a reflection, it's got to be, of supply and demand, that the way technology has evolved over the last several decades has increased the demand for skills at the workplace. And we as a society have not kept up in supplying that. If supply had kept up with the demand, you wouldn't have seen the widening price on skills. So to me, the evidence is very clear that there's a gap that's growing, a need to think harder about investing, think harder about how our economic system thought of broadly, and families. What are we doing to provide our children with the human capital they need to thrive in the new economy? Because ultimately, at the end of the day, human capital, the growth of human capital, the terms economists use for the skills, the knowledge, the insights we have, the kind of things Brian was talking about, ultimately that is the fundamental engine of growth and prosperity and standards of living over time. So I think it's an area where investments would pay off handsomely.
We have less than 15 minutes left, and So we have less than 15 minutes left, and I want to ask a couple questions about the softer science, not so much about the harder science. David, I'll start with you for better or for worse. Trump and Sanders. Not asking you who you're voting for, David.
What about Trump and Sanders?
So,
They won't be
what maybe I should ask Brian. What is that? What does the popularity of not, you could say it's toxic dialogue, and to take the politics out of it if it's possible, what is the advent of Trump and Sanders in this presidential election cycle? What do you think that represents?
I'm not a political junkie, but to me, it's not surprising. It just reflects just how polarized our society is, and they are on opposite extreme ends of the political divide, and obviously they're getting traction with substantial people that their message resonates, whether it's around the skills gap that we talked about, whether it's income inequality, whether it's this week, this month, this quarter, it's all around security. And our country is terribly polarized. We see it locally, politically, and I think they are the caricatures that represent that.
Brian, is this another manifestation of the political acrimony, as David talks about? Does this mean something different to you?
Well, I think this is a worldwide phenomenon, frankly. So as you watch the elections across Europe, you're seeing the same thing play out, which is the series of issues: security, economic equality, skills gap, wages, immigration, you pick it, are playing into people going sort of left and right and to the ends, because they're very different debates about capitalism, social capitalism, socialism, and I think it's going on, and it's going on among young people around the country, and so I think, I'm not sure I find it as different personally, that I thought this goes on all the way. The question is, what's interesting is how it will resolve itself, I think, has people more interested in your business than our business, which is, you talk to people in the press and stuff, this is really fun to think about conventions that could be different than they've ever been, and it isn't all over in the first month of the election, and it's great for advertising dollars and things like that. And so, but I don't think it represents, the issues are maybe more stark, the issues are more presented more starkly, but I think this basic question of what is the basic economic political structure we want in a country, and how we're going to run it is not different, and it's going all over the place. And it's exacerbated by these issues of externalities such as immigration or terrorism or how you play defense, how oil affects you, whatever it is, and people are struggling with it.
Would you expect, as we get closer to the November elections, that the fallback positions will be standard operating procedure, and the Republicans and the Democrats will end up doing?
I think that's the debate, will it be? And I think everybody thinks it will be, because it generally is. There's always a process, but the question is, I don't think people see the path to that as clearly as they've seen it in past election cycles. In other words, it used to be, people are saying by this time, I'm not sure they're right, but they feel, the people that follow us closely feel that we're longer into the cycle without sort of a path to a resolution. We'll see.
I think the real challenge is, and people don't think about the presidential election necessarily as connected to Congress, but the challenge we have is that if we end up having party in control in Congress, party in control at the president level, you can get a lot of stuff done, but does it go to the extremes, and is it challenging? If you have a different party in control in Congress and then a president, you can't get anything done. Mm-hmm. And so the challenge that we have as a country, I think, not only in the presidential election, but in all the Senate races and the House of Representatives races, is how do we get to a place where we have healthy dialogue, bipartisanship, and people really working together? And I actually think that the challenge is we have one or the other, and neither one of them work well.
Yeah, Lynn, so do you... well said. Lynn, is there a way back to respectful dialogue? Not agreeing, but respectful dialogue?
It seems as if we've lost the art of compromise. And when you think about the issues that are being bantered about, whether it's immigration or, in my business, an energy policy for the future, or how we're going to address something as monumental as changing climate, it's not something that any one stakeholder has the answer to. And so when you're talking about issues that will be worked over decades, I think the only way to get to them is to come to the table and try to hear one another and develop points of view and compromise that can move us in the direction over time. And it just seems as if we've lost that art of the compromise. And thank you. What we find when we're trying to wrestle with a tough issue in the energy space, whether it's in our states or at a federal level, we are always looking for other points of view that are willing to sit down and work on a tough issue over time and try to find where are their points of agreement. And when you can get that kind of dialogue, you're going to get to some degree of answer, and then you're at least moving forward. And I think when things move forward, then you get the feeling of success, and you start to create some momentum, and then more change can occur. But it has to start with talking deeply about the tough issues, and I hope we can get to that point at some time.
Private sector leading. I mean, all of us are in highly regulated industries, and that consumes an inordinate amount of time and energy around compliance with regulations that, in a way, lead it to a more bureaucratic approach as opposed to a private sector approach.
So, Susan, which is a good point to ask you. So, how do you, as someone in the healthcare business, how do you engage politicos and not have them think that the motivation is for you to get some particular advantage in your healthcare, but really that you want to have a better debate and a more respectful dialogue?
I think actually when you get beyond the rhetoric and you get down to talking to people about real issues of quality or safety or genomics or new invention or taking care of populations, they really want facts and they really want data and they really want information. So we talk to both sides of the aisle because one of the biggest gaps is actually education in the understanding of the healthcare industry so that the people in political positions can make decisions. So we do it all in a fact-based, experiential way so that they really understand what's happening in health systems, what's happening with pharma companies, what's happening with medical device companies.
We have 5 minutes left, and I'd like to kind of go down and tick off what you're most encouraged about in 2016. And Tim, we'll start with you. What are you looking forward to? What do you think is going to be good for 2016?
Well, personally, I'm looking forward to getting back into the business of business. Now that we've had this deal behind us, I'm looking forward to getting re-engaged in that. And I feel like the prospects for growth are good. This 2% is a good number, and I think we can get excited about that. If we execute well, we can achieve a higher rate of growth. So I'm looking forward to spending more time in the market, in our stores, developing some of these new skill sets that are where the high growth is in our business, in the digital side.
Healthy consumer spending, would you expect that?
I think so. I think there still could be some choppiness in that, but I think, I'm feeling better about that. The economic trends seem to be gelling.
Is there not to go too far down this rabbit hole, but is there a challenge for traditional stores as they have lived in malls, and what is going to happen with foot traffic, and what about online? How does all that pan out in the next year or so?
Yeah, there is a challenge there, but stores are not going away. Our challenge is how do we make that experience seamless for the customer so that they can move from store to web to their mobile phone. How can we make these things very easy for a customer? And that requires a lot of investment, a lot of skill set building.
David, what are you most encouraged about?
Like I said earlier, I'm pretty bullish on next year. I mean, we see 2.5% GDP growth, but Dr. Lacker pointed it out, there's a lot less leverage in the system. Everybody's deleveraged except governments, but notwithstanding that, I see good balance in the economy. You've got employment growth, you've got wage growth, financial assets are reasonably priced. There's a lot of liquidity in the system, and our economists are always talking about animal spirits. I think business people want to invest. They want to put capital to work. And absent some big exogenous event, I think next year is going to be a good year.
Yeah. Susan, what do you think?
He said animal spirits, and it made me think that I'm thrilled we now have a clinical coding system that has gone from 19,000 ways to diagnose something to 142,000. And we now have 9 codes for injury by parrot. 3
right.
for burns from flaming water skis. This is all true. And 1 for distress caused by in-laws. So he just made me think of that.
I don't know where this is going, Susan, but we're going to have to wrap it up.
No, we're good. No, I am encouraged by the momentum around the discussion and employers who understand the cost, understand the quality and the benefit and the forward movement, because I've been in healthcare for a very long time, but the forward movement to really change the way we're delivering it to make it more effective is very encouraging.
Thank you. We have a minute left. What are you encouraged about?
So I'm encouraged by a merger that's off to a good start and hopefully a successful closing of Piedmont and more infrastructure on the docket for Duke. Gas pipelines, renewables are front and center.
Dr. Lacker?
I'm encouraged we finally raised rates.
What can you say past that, right? Thank you.
I mean, we did. It was a sign of strength, really, because the improvement in the well-being of the American consumer, their ability to spend, their disposable income going forward, that coupled with the tremendous innovation going on all over the U.S. economy has been very encouraging.
And Brian, sorry, 15 seconds. What are you encouraged about?
I'm encouraged by 215,000 teammates to go out there and do a great job for the customers and clients, and they'll go do it again next year.
Yeah. Well said. Thank you. Thank you all. Gosh, thank you for being here. Happy holidays. Brian Moynihan, thank you for being here. Dr. Lacker, it's always good to have you here. Lynn, best of luck going forward. Thank you. Susan, you are excited about your industry, so I'm excited about your industry. Thank you. David, thank you for your leadership. Tim, well done, and thank you for being here. Thank you all for being here as well. Happy holidays. We have a lot of blessings and a lot to be thankful for. Until next week, good night.
You've been watching the 2016 Economic Outlook Conference, a Carolina Business Review special presentation. For more information, visit carolinabusinessreview.org.